For months, Russia's economy looked stable, but that stability was an illusion. The war bill has arrived. Cash is draining fast, and the numbers no longer add up. Today, we're breaking down where the money is going and why this pressure is getting harder to hide. For more than 2 years, the world watched a spectacle: the apparent resilience of the Russian economy. Sanctions were supposed to cripple it. Instead, Moscow boasted of growth, of industrial output surging, of a nation seemingly immune to the West's most potent financial weapons. We were told the sanctions had failed. We were told Russia had cracked the code for surviving a long, grinding war. It was an illusion, a magnificent, terrifyingly effective fiscal facade, powered by two things: unprecedented oil windfalls in the first year of the war, and a monumental, politically untouchable defense spending spree. But the era of fiscal anesthesia is over. The defiant speeches have stopped. The oil money is shrinking, and the inevitable is finally happening. The bill for the largest land war in Europe since 1945 has arrived, and it is not being sent to the oligarchs or the political elite. It is being paid by shop owners, pensioners, drivers, and the millions of ordinary Russian families who have no escape from the system tightening around them. The illusion of unstoppable growth, fueled by military orders, is now stalling. This is not a technical adjustment. It is a structural breaking point. The choices facing the Kremlin are no longer about growth, but about survival. They must choose between the war and the ruble. And their choice is clear. The Russian people will pay the price for the war machine. This is the story of how Russia's economic fantasy is shattering, why the next 12 months will be the most financially painful yet, and how the Kremlin is now reaching directly into the pockets of its own citizens to sustain a conflict with no clear resolution. To understand the crisis, you must follow the money. And today, the money is pouring into a black hole the size of Russia's federal budget deficit. When the war began, the Kremlin claimed it could easily manage the conflict's financial cost. Those claims have been obliterated. By the end of this year, the federal budget deficit is projected to have swollen to an estimated 4.3 trillion rubles, a figure that is politically minimized but economically devastating. This is the weight of the war, a debt bomb exploding within the economy itself. The most immediate threat is the financing mechanism. Unlike Western nations, Russia cannot simply tap into international bond markets or rely on foreign lenders. It must rely on its own internal resources. And the primary internal resource is its rainy day fund, the National Wealth Fund, NWF. For years, the NWF was the symbol of Russia's strength, a sovereign wealth fund built on oil and gas profits, meant to stabilize the nation during times of crisis. Today, it is an incinerator. The fund's liquid assets, the cash that can actually be used, have been dramatically depleted, standing at roughly 4.0 trillion rubles. That is the entire safety net. The Kremlin is burning through the NWF's liquid reserves at a staggering rate, selling off Chinese yuan and gold to cover the cost of the war. At the current expenditure rate, and factoring in dwindling oil revenue, experts project that the NWF's liquid, usable assets could be effectively depleted within the next 6 to 12 months. Once that happens, the government will face the ultimate financial crossroads: either cut military spending dramatically or resort to inflationary money printing on a catastrophic scale. The other major structural drain is the cost of military expenditure itself. Putin has greenlit a defense budget that is now consuming an estimated 7.1% to 8% of Russia's GDP in 2025. This is the cost of maintaining the war machine at full throttle. To put that in perspective, this percentage far surpasses the Soviet Union's military share of GDP in the 1980s, even during the height of the Cold War. This is the militarization ceiling. Once defense spending breaches this level, it does not just crowd out the civilian economy, it actively destroys it. Every tank chassis manufactured, every missile assembled, is a missed opportunity for the non-defense sector, sucking up labor, capital, and technology that could have been used for productive, long-term growth. This is the essence of the structural collapse now underway. The entire Russian fiscal system is built on a single, fragile foundation: oil and gas revenue. This is the lifeblood of the budget. And this foundation is cracking. In the first 8 months of this year, Russia's oil and gas revenues saw a devastating year-on-year decline of approximately 20%. This is not a temporary fluctuation. It is a profound structural failure driven by sanctions and a masterstroke of geopolitical financial engineering, the price cap coalition. The initial Western strategy to completely ban Russian oil exports was judged too risky, fearing it would spike global prices. The solution was the price cap, a seemingly complex mechanism that, in practice, operates as a massive, invisible tax on the Russian state. Here is how it works. Russia is forced to sell its Urals crude at a steep discount to the global benchmark. The new, floating price cap ensures that Russian oil will be sold at a price approximately 15% below the market price for comparable barrels. This is the Urals discount. While the stated cap is technically $60, the new mechanisms of enforcement push the effective selling price for much of Russia's crude closer to $47 per barrel. This low price erodes Russia's profit margins, forcing it to sell its oil at levels barely above, and sometimes below, the cost of extraction and transportation. The result? A perpetual state of underfunding for the state budget. But the pain doesn't stop at the barrel price. Russia has been forced to create a vast, expensive shadow fleet of old, often uninsured tankers to circumvent the Western shipping and insurance ban. The operational costs of this dark fleet, maintenance, illicit insurance premiums, risky transport routes, are enormous, and they must be subtracted from that already discounted $47 barrel price. This means that for every barrel sold, a significant portion of the revenue is immediately consumed by the cost of circumvention. The result is a system of permanent fiscal leakage where even when the oil flows, the profits necessary to fund the war and sustain the domestic budget are being bled dry by the logistical and financial costs of fighting sanctions. The once mighty oil leviathan is starving, and its emaciation is directly translating into a crisis of funding for the war effort. The fiscal black hole and the starving oil revenue are just the symptoms. The real disease is the collapse of the underlying structural economy. The war economy bubble has masked three critical and potentially irreversible failures. The labor chasm. Official Russian unemployment figures are near historic lows, often cited as a sign of economic health. This is a cruel distortion. Low unemployment is not a sign of strength. It is a signal of acute crisis, a wartime distortion caused by two factors: military mobilization. Hundreds of thousands of working-age men have been pulled from the productive, civilian sector into the military, either through enlistment or conscription. Immigration. The most educated, highly skilled Russians, IT professionals, engineers, academics, have fled the country in droves, taking their intellectual capital and tax contributions with them. The manufacturing sector, logistics, and non-defense industries are reporting crippling labor shortages. This means that even with money available, new infrastructure projects cannot be built, factories cannot run at full capacity, and necessary civilian goods cannot be produced efficiently. The war is not just killing people. It is actively starving the civilian economy of its human capital. Technological atrophy. Russia's reliance on parallel imports, smuggling in everything from microchips to machine tools via third countries, cannot sustain a modern, industrialized economy. While low-grade consumer electronics might flow in, the high-precision equipment required for advanced manufacturing, aviation maintenance, and energy technology is drying up. The result is technological atrophy. Over time, Russia's capital stock, its factories, its power plants, its aircraft fleet, will degrade without access to proprietary parts, maintenance, and software updates. This creates a systemic time bomb. The war machine can be sustained for now by cannibalizing consumer goods and diverting all available high-tech imports to the military-industrial complex, MIC. But every other sector, from agriculture to healthcare, is forced to operate with aging, less efficient technology, locking Russia into a path of long-term economic development. The crowding out catastrophe. The sheer scale of military spending creates a self-fulfilling prophecy of economic failure. The government must borrow massively to cover its deficit. This borrowing, mostly done through the domestic banking sector, drives up the cost of money for everyone else. This is the crowding out catastrophe. With the central bank already fighting inflation with a punitive 16.5% key interest rate, as seen in the provided context, the state's demand for capital leaves the private sector with nothing. Why would a Russian bank lend money to a local business for a new factory when it can get a virtually guaranteed, high-interest return by lending to the government for the war. Private investment is being strangled. Entrepreneurship is dying. The focus is exclusively on the state-led, military-driven economy, ensuring that once the war ends, the civilian productive capacity of the country will be a hollow shell. This brings us to the final, most revealing chapter of Russia's economic crisis. The moment the Kremlin shifted the cost of the war from the distant budget to the daily life of every citizen. Facing the collapse of oil revenues and the exhaustion of the NWF, the government had two choices: cut the war or raise taxes on the people. The choice was swift and brutal. The Great Tax Squeeze. The most significant action is the overhaul of the tax code, a collection of measures designed to transfer the war debt directly to the populace. The VAT hike, the value-added tax, VAT, a levy on nearly every single transaction, is scheduled to rise from 20% to 22%. This may sound like a minor adjustment, but its reach is vast. VAT is embedded in food, clothing, transport, and household goods. When it rises, prices rise with it, hitting the poorest households, pensioners, and low-income families the hardest. This is a universal, unavoidable tax on existence itself. The small business decimation. The Kremlin is dramatically lowering the revenue threshold that determines which small businesses must collect VAT, dropping the limit from 60 million rubles to as low as 10 million rubles. This dismantles the buffer that protected small grocery stores, beauty salons, and neighborhood cafes operating on thin margins. They are now swept into the tax net, facing higher administrative burdens and costs that will either be passed on to the customer or absorbed until the business collapses. The state is actively choosing to deconstruct its own small to medium enterprise sector to fund the war. The consumption taxes, a cascade of new levies, are hitting everyday consumption. Steeper taxes on spirits and beer, rising fees for driver's licenses, the elimination of key tax breaks on imported cars, and even a tech tax on digital devices. The message is clear: every single daily activity is now a fiscal extraction tool for the state. The inflation feedback loop. These tax hikes are pouring fuel onto an already raging fire: inflation. The central bank has desperately hiked its key interest rate to 16.5% to suppress price rises. Yet inflation remains stubbornly high, fueled by the government's own military spending. The VAT hike will initially push prices even higher as merchants revise their price lists overnight. As costs rise faster than incomes, workers demand higher wages. Employers, already squeezed by the high interest rates, pass those costs along again. The result is a devastating inflation feedback loop that the central bank is fighting a losing battle to control. The finance ministry's spending is fundamentally undermining the central bank's mandate for price stability. The ultimate sign of social stress is the collapsing financial health of the average Russian. Non-performing loans, NPLs, debt that is not being repaid, are spiking, estimated to be as high as 12.1% in some sectors. This is the human cost of the crisis. Families are drowning in consumer debt simply to maintain their existing, pre-war standard of living. When inflation eats away at savings, when wages cannot keep up with the tax-induced price spikes, the average Russian has no choice but to rely on credit, creating a massive consumer debt bomb that threatens a systemic liquidity failure across the Russian banking system. The Russian economic illusion is not just cracking, it is shattering. The decision has been made at the highest levels of the Kremlin. Military survival trumps economic vitality. The state has exhausted its emergency funds, its oil revenue is structurally impaired, and its civilian economy is rotting from labor shortages and technological decay. The next year will see the consequences of this choice play out across the Russian home front. Growth will slow, prices will climb, and taxes will rise. The once promised idea that the war would strengthen the nation economically will ring increasingly hollow. The war is no longer a distant, geopolitical struggle. It is a line item in every Russian family's monthly budget. The Kremlin may still have the funds to fight for the foreseeable future, but the margin for error is gone. Every fiscal move is a reminder that the state is reaching deeper and deeper into daily life to sustain a conflict with no clear resolution. The bill has been paid by the people. Now, the economic decline truly begins.